favorite quotes is that the market can stay irrational longer than you can stay solid.
Yep.
Okay. It doesn't matter if the market agrees with you or not. So I love that quote, but you touched on this a minute ago, and I think we got interrupted and never really got to spend more time on it. But it was almost this cycle of humility, right? Where success breeds arrogance, which then makes you stupid and makes it harder for you to replicate your success, right? So
that's a great way to put it. That's a great way to put it. We see that all the time. You know, we have a proprietary screening method that we've developed that works really, really well. And it's based off of earnings growth. It's based off of sales growth. It's based off of, you know, and analyst ratings, all kinds of things. Okay, but it starts there. And then when we go, and once I kind of start, I build we'll build the general chassis of what the portfolio is going to look like. Then I'll start to, that's when I go into the technicals and I start to do comparative analysis of this stock. Okay, if I want to get rid of this one, you know, if I want to add Palo Alto Networks and I want to get rid of Disney. So let's compare the two. And see, is Palo Alto in the nascent or in the stages of outperforming Disney? Okay, because maybe the earnings growth on Palo Alto Networks is really strong. The growth is really, really strong. The price compared to their growth is much, much better. However, they could be far more expensive. So maybe we need to see what the market's saying as a comparison. So I'll compare the two directly inside of one chart, and it's really great. I can do that, and that lets me know, okay, I think this is a good decision. What does the market think? What is the market saying? What is the market telling me? Because again, it doesn't matter if the market's right or wrong. The market is right. You have to respect the decision of the market, and then I can through this program, I can look at: are we in the nascent stages of this change? Are we in the middle stages of this change? Or this outperformance? Or are we in or is it starting to roll over and potentially going the other way? Am I late to this? Am I late to this game? Right? And I can do, and that's what we look at. So that's where we use a lot of technicals for is where are we at? I like this for these set of fundamental reasons, but where are we at in this trade? Are we too far down the road? Are we going to roll over soon? And we're not going to be 100% correct, of course not. But it gives us an idea of what the market's deciding on. So you just have to understand both sides, just like you have to understand, you know, you have to be a good fixed income manager to be a good equity person, a good equity manager, in my opinion, and be able to bring them together. You know, as we're looking at the markets, we're looking at the bond markets this year. You know, we really grabbed it last year. It wasn't probably the best thing to do, but we grabbed pretty much the long end of the curve using the TLT, the 20-year. This year's different. You know, as we think the shorter end of the curve is going to come down, and the spread of the mortgages are going to come into more of a normal range. Typically, we see that range 1.65% between the 10-year Treasury note and the 30-year fixed mortgage. That relationship is 1.65% historically. It's much higher. That's about 3% right now. Okay, so as the Fed starts to lower rates on the policy end, starts to lower their policy rate, that's going to bring that short end of the curve down. That's going to bring mortgage rates down. That's going to tighten up that spread. So we're not going into real estate this year, but we're going into mortgage-backed securities on the fixed income side. And then we're really going to grab that belly of the curve. We've got the mortgage-backed securities, and then we've got a big position in 3 to 7s, and then we've got a big position in 7 to 10s, and then we have another smaller position out in 10 to 20s. We didn't just grab the 20. See what I'm saying? And I know as those start to come down, we think industrials are going to do much better in this space. We think healthcare is going to do really well this year. We think tech is going to continue to outperform this year. We think comm service is going to continue to outperform this year. And we think consumer discretionary is going to do well this year as interest rates start to come down, autos, home, those things will start to do better. So there absolutely is an overlap there. Again, back to that Venn diagram. But as we look at these things, and I was doing some analysis here on 2024, 2025 earnings growth as on these different sectors as viewed through the sector ETFs, right? So like industrials, you know, we're seeing about 11.2% earnings growth this year and 13.3% in 2025. Okay, that looks good. Tech, 14% earnings growth this year, probably 17% in 2025. Now it's a more expensive sector, but I think it's still growing. So when we juxtapose that against, I don't know, let's pick on home builders. I like home builders in a decreasing mortgage rate environment. Earnings growth this year is going to be 2.8%, 2025, 9%. I think it's going to be a strong sector, but there's going to be less earnings growth. A lot of people are bullish on banks this year. Okay.
On what?
I don't know that they're going to be wrong or right. I don't know, but through an earnings spectrum, we're looking at about 6% earnings growth this year and about 11.5% next year. Okay. Again, relative selection. Do I want to be there? Do I want to be in healthcare where it's probably 20% this year and 13% in 2025? And again, back to tech and small caps is viewed through the IWM. We're going to get 26% earnings growth this year, and 24% in 2025. So, as I start to look at these earnings growth patterns, okay, then I go into the technical side and start comparing the two against each other. Okay, let's look at the XLF against the XLV. Okay, is the XLF underperforming and continuing to underperform? I don't want to be in that trade. I want my charts up and to the right. Okay, that's what we do. In fact, we talked about that in I believe it was one of our earlier shows. It was middle of October. We said there was going to be a chase toward the end of the year, and we got it. Yeah. What are you going to step into? You're not going to step into anything that's going down, hoping it's going to turn and go the other way. You're going to step into whatever positions you can that are up and to the right, because you need to get on that road. You need to get on that road. So that's
that's the concept. And that's the concept of not catching the falling knife. A lot of people will say, don't try to catch the falling knife. So the fact is, whether that's good philosophy or bad philosophy doesn't matter. The fact is, it's real philosophy, right? Like, it happens. So there's a reason that it's very hard to change the direction of a falling stock. It's because most people avoid those. I mean, there are all these different, they're not even fallacies, they're just approaches. The fallacy is ignoring them. You know what I mean?
Yeah, that's happening right now, actually. Sorry to interrupt. But I think you're going to see a lot of people try to catch Boeing. Right now, Boeing's down from 260 down to 210 or 215 right now. I think you're going to see a lot of people trying to catch the bottom of this thing. We took a quick look at this. I think it's probably going to go to 185, 190 before I would get brave with it. You see what I'm saying? So,
and that's where there's that.
I want to see it go there and then turn around and go the other way. I want to get on the plane. I don't want to try to catch it.
Yeah. And I think that's a great point there on the concepts of the show and what you said earlier about theory versus like real time, because that's a theory that I totally agree with, but it can be 30 minutes of show. We can bring up 2 minutes of that to talk about a real example right now, like Boeing, right? But the point is, it's all of there is such a delicate dance, and there's such a choreography really to navigate in the markets the right way. And it takes understanding the science behind what you need to do, plus the analytics and the art form of understanding that everybody's opinion matters. Whose matters the most today is what's very fluid.
Right.
Well, dude, before we go, let me make sure we're clear on this, that the Intelligent Investment Market Update is for educational and informative purposes only. Neither myself nor Matt know anything about your personal financial situations. Therefore, we should not be giving you investment advice, so we are not. Would your attorneys like you to say it differently, Matt?
Absolutely not. Please consult your own investment professional for any of your portfolio.
Or Matt.
Or feel free to give us a call right here at ARPG. Our number is 702-655-8300. Any one of our advisors would be happy to talk with you and get you pointed in the right direction.
There you go, my man. I think we just nailed the exit. I think that's the permanent outro right there. Perfect.
Make sure your weekend is up and to the right.
See you, man. Talk to you soon.